the current state could really be broken down into a couple of different areas. The first would be regulation and supervision. We still see huge fines, I think in the billions per year. And we're seeing large failings behind that, even still from some well-known banking names. The European Union, EU, has announced, obviously, they're setting up a new AML authority for coordination. So we're starting to see a move towards greater coordination across wider geographic regions. And that coordination is very welcome, but the speed of reactivity is still something that's lagging. Crypto is now over a decade old. Not just, but still relatively recently have seen regulation coming out trying to govern crypto. We're still very early days on that space. So that speed of reactivity really needs to improve. The second thing would be around the actual financial crime that's taking place and what that looks like. So typologies do tend to shift a little bit with advancing technology. So we see new payment methods, new payment technologies, but as technology in the financial space moves, so do the methods that criminals are using in order to move their illegal funds around. So as technology in the financial space increases, so does the methods of criminal activity. And especially given that technology in financial services is moving us more towards borderless, frictionless, instant set of affairs, that is very much the advantage of criminals should they choose to use it. And we are always lagging behind them. A third thing would be around the tools that we're using. So we've looked at supervision and regulation, looked at what financial crime is actually taking place and what tools they have available to them. But there's also the tools available to us as AML professionals. Most of the tools that most of the large banks use remain quite weak, very static, very much based on legacy infrastructure. So it can be quite difficult to improve on that if your baseline architecture and your data is a bit messy. And we're also very uncoordinated. So in all of that space, both in terms of the tools and what we use to combat it, but the regulation and supervision, none of the players on any sphere are really working together yet enough. And until they do, we're not really going to be able to move forward. So AI obviously stands for artificial intelligence, often used as kind of bucket term for artificial intelligence and machine learning. What we're really trying to do in AML specifically is harness huge data sets that would be far too much for the human brain to compute or assess, and seek deep insights in that mimic the problem-solving, decision-making, and analytical abilities of a human. We're able to digest that huge data and find new insights, new patterns, and hopefully from many different sources in a way that we wouldn't have been able to with these static thresholds that we've really been using. So that static expectation of behavior leads to as much as 99% false positives. With AI, what we're able to do is demonstrate a much higher level of both efficiency and effectiveness. So as well as getting false positives down, we have managed to uncover new patterns of behavior and to really harness where those high risk factors are, which will lead to a greater likelihood of it being something that we report. Particularly when you're dealing in a regulated space, there's a lot of conservatism and a lot of reticence to do anything that is new, unknown, untested, right? Those assessments and those examinations that we go through are really hard enough without us also having to fight for using new technology that a supervisor or an examiner may not have actually heard of. We believe, rightly or wrongly, that regulators want to see tried and tested methods, tried and tested names, and with AI, it's seen as unproven, untested. There's a huge element of it which is unknown and certainly not understood. And so without that understanding, without that education and that training almost of regulators, I believe that compliance officers and financial institutions generally will be quite reticent to adopt something new. If you're working off legacy technology, you've had something in place for decades, to then go and say, we're going to uproot all of that and try and do a migration can be particularly tricky. Our AI model looks for a variety of risk factors and then consolidates them to assess the likelihood of a payment being one that is worth escalating up to compliance or ultimately filing a SAR on. We're actually looking for a broader array of factors, which is much more akin to how money laundering actually works in the real world. That means we're more efficient, we bring down our false positives, and it means we're sending out fewer queries to our clients. So they're being bothered less, which I think is really key for the customer experience. When we look at our AI, we did some analysis between 2019 and 2021, and we saw that as payments had gone up 150%, the number of alerts that we actually generated had gone down 30%. So we're getting much more effective, much more efficient in what we're doing. Great for our customers, great internally as well. It can scale without having to hire loads more people, and everyone in the chain ends up better off.